Rounding up a busy week for economic data here in South Africa, the Kagiso Purchasing Managers Index has disappointed, falling back below the break-even threshold of 50. Of course, this week's also seen inflation releases, the trade balance and credit growth numbers as well. Joining me with more on these are Dennis Dykes, Chief Economist at Nedbank, Theo Vorster from Kagiso Securities. And Theo, perhaps starting with you, after improving for 2 months and heading back above 50, we've taken another step backwards in the manufacturing sector here.
Yes, good afternoon. It's disappointing. I think we were hoping that we would remain below the critical 50 level. Remember, if the index is below 50, that means the sector is contracting, and we're back below 50, which is not good news. I think if you look at some of the PMIs in the rest of the world, although some of it is down, it's a mixed picture. They're still above 50, and we would have hoped that this number would be above 50. I must say, it is disappointing. It is not really what we expected. If you look at the previous month, the portion of the indexes that were looking forward was actually quite optimistic. That did not materialize. Now, you can say that the automotive strike did play a part, and so did the component manufacturing side play a part in the business activity, because that's one of the key components that was down, was business activity. But if you look at all the components, that the sub-indices, all 5 of the major sub-indices were less than last month. They weren't all below 50, but all 5 of the big sub-indices were actually weaker than they were a month ago.
Dennis, what's your view on that? Because of course we know everything doesn't go up in a straight line. Would you see this as a temporary blip, perhaps exacerbated by the strikes we saw last month?
Yeah, look, my view of most of the statistics that have been coming out over the last little while, not only here but internationally, is that after the big move up in the second half of 2009, that we have lost some momentum, that we're definitely going through a phase whereby we're either going to start regaining momentum in the latter part of this year into early 2011, or we're going to lose momentum even still further. So, I mean, this is quite concerning. And the element within this that worries me the most is that, you know, employment remains below the 50 line. Prices well above 60 still, which just shows you. So people feel that they've got the pricing power, but they're not employing more people, which doesn't make a lot of sense either.
We saw last, so you wanted to add something
yes,
to that? Yes,
the employment number, this sector is shedding of employment opportunities for the 5th month in a row, which I agree with Dennis, that is a major concerning factor. I think the higher prices, that's probably also was reflected yesterday in the higher than expected PPI number that we're seeing. But unfortunately, it's the employment number and the current business activity that is of concern.
Of course, we know, I mean, as you mentioned, PPI yesterday, we also had the trade balance yesterday, disappointing a little bit with that big deficit after those surpluses. But we know there have been problems in the system, perhaps. So for last month, we had a derailment of a train, so we couldn't get iron ore to port. So those things do affect sentiment, don't they?
Well, they affect sentiment, but they also affect current business activity, and that is where we're down. One of the aspects that was dramatically down was the performance of suppliers to the manufacturing sector. Now, let me explain what that is. That means if you are in the production cycle and you supply to the manufacturing sector, what the sector is telling us that the suppliers performing into them is actually doing a lot better than you would expect, which means they're not under pressure, which means there's no bottlenecks in the system, everything is available, everything can be delivered, and we read that if the manufacturing sector tells us that a supplier can do whatever you want them at whatever time, it shows you that there's no pressure even in the chain looking backwards. So there could be elements that influences, as the automotive strike is, as what you're talking about, some of the export side. But the fact of the matter is, all the 5 major elements were all down on a month before. I hope this is a blip, and I do think that we can't use 1 month worth of data in this type of segment to try to justify or to say that the trend is turning. But that doesn't mean, the fact remains it's a negative number.
Of course, Dennis, we had Chinese PMI out this morning, a little bit better than expected at 53.8. German PMI under pressure, French PMI up, Spanish PMI below 50. So it really is a mixed picture wherever you look. I think we had the Chicago PMI last night out in the United States, and that was better than expected. How are you reading the picture globally? Because we are seeing divergent pictures here.
Yeah, I think it's very mixed. I mean, we're not seeing... I think earlier in the year you had PMIs that were in the upper 50s and, you know...
Even 60.
And even 60s, you know, and basically it was suggesting that having come from a severe trough, things were improving fairly rapidly. But, I mean, these things only look back to your earlier base. So it suggests to me that there has been some faltering in the momentum in the global economy just generally. And, you know, as was mentioned, you are going to see numbers up, numbers down, but it does seem as though the earlier momentum has faded to somewhat.
Perhaps taking it along with some of the consumer inflation data we saw earlier this week, very benign. We know that growth is under pressure at this stage. We're not growing to potential. Given the PMI, do you think that could help to force the Reserve Bank's hand in cutting interest rates again?
Yeah, it could do. I think that my personal view is that they'll probably hang 10 in November. They've just recently cut interest rates. I don't think inflation was significantly below expectations. I think the general expectation was 3.6, coming out 3.5, that sort of thing. So I don't think that would have shocked and surprised them too much. But having said that, we've had a very, very strong rand. But my view is that they'll wait until the early part of next year, and then if the growth numbers in particular disappoint, they'll probably move again early next year.
Would you agree with that, Theo? And
Yes.
also, just given where the rand is at the moment and the fact that it could strengthen with that euro now going above 137 against the dollar, don't you think they'd want to perhaps cut interest rates to help try and weaken that rand?
Look, I think this one PMI number is not enough to change the interest rate scenario. I do, however, think this is part of the evidence that will take into consideration if they look at a cut. But this one number and this one down number is definitely not enough. I agree with Dennis. If we see this type of trend continuing, and if we see that the manufacturing side is actually remaining under pressure and that continues, and you're quite right, the rand will not assist the sector. A portion of that sector is based on the export market, which obviously will have a negative impact on the overall growth. Remember, manufacturing is about 15% of the GDP. So if the manufacturing sector remains under pressure, if the rand remains strong, this type of number will add to the motivation for perhaps a cut. Alone, I don't think this will change the playing field.
Yeah, I mean, the other side of course, is that we've had credit numbers which look a little bit better. The cycle's turned. It doesn't look very vigorous, but it has actually turned. And that might give them some pause for thought, you know. So you're starting to see maybe a little bit of resumption of consumer demand coming through. Manufacturing side doesn't look all that strong. Mining doesn't look all that strong. But maybe the solution isn't in interest rates.
How about the rand here, though, Dennis? Because, of course, we do have the MTPPS coming up in just a few weeks' time. And we had at the beginning of this week headlines about the currency wars, quoting Brazil's finance minister and the problems they face with a strong real at the moment. Do you think that steps are going to be taken, policy changes perhaps, during the mini-budget?
Well, I think we've had fairly strong indications from various people in Treasury that they don't like moving taxes in the medium-term budget policy framework, that they prefer to actually leave that to the actual budget itself. So I'm not really expecting anything to happen there. However, we do have a whole raft of international meetings over the next few weeks, and I think the solution to this is probably more multilateral solution. You know, individual countries, as we've seen with Brazil, they imposed a tax on short-term capital towards the end of last year, in October last year. It really hasn't had much in the way of effect. There's been significant intervention. That hasn't had much in the way of effect. I think you need to get finance ministers, central bankers around the world to sit down and look at the threats, because the ultimate threat is, of course, that you start to see protectionism growing because of the movements in currency, which would be completely undesirable.
Do you think this is something that can be addressed on a multilateral level?
Look, I'm pessimistic, or I question the ability of governments to necessarily change this without unintended consequences. And there I believe that it's very difficult, and history has proven that it's incredibly difficult to try to manage the level of a currency without having consequences, like protectionism, one of them, but without having consequences that is negative for the system as a whole. The solution probably lies in the key elements, and that key element is, as long as some of the first world countries cannot get their economies to grow at a more normalized rate, get their interest rate yields at a normalized rate, this type of thing is going to remain a problem. And it's a matter of where there's yield and where there's growth, and that what money is going to follow. To try to govern that, to regulate that, I think that's going to be very difficult.
Dennis, just perhaps looking at jobs, and we talked about the employment components of the PMI. We've had the IMF saying on a couple of occasions now that we do need growth north of 6% if we want to create jobs. We've had the government saying they'd like growth of 8% to create jobs. But we're looking at growth of 3% or less this year. Where do you think we're going? How are we going to change that growth trajectory in the economy?
Look, I mean, obviously it's against the background of a weak global economy, so that makes it very, very difficult. But I think there are a number of very important and basic things that we can actually do locally. I mean, obviously we've got to continue and go ahead very strongly with infrastructure programs. We've actually got to look at ways of including first-time employed into the workforce to actually try and boost the employment, to provide on-the-job skills.
That was something they tried to address in the budget this year, wasn't it?
They actually mentioned it in the budget. The wage subsidy sort of idea, it's been pushed forward on a couple of occasions, very much vetoed by COSATU, who feel that it might actually erode their own members' sort of bargaining power. But I think everyone's going to take a mature look at this. The education system's failing, so we do need on-the-job training. It's no good just saying, oh, well, that generation's lost because we made a few mistakes on the education side. We've really got to accommodate them. And the best way to do that would, I think, be through something like the wage subsidy, or indeed through the creation of industrial development zones or something of that sort of nature, whereby you could maybe suspend some of the rules and start including some of these people who are actually very, very desperate.
Yeah, despite some of the hurdles we're facing at the moment here, we have a number of big international companies wanting to get into South Africa, and of course Walmart just the latest this week to announce its intentions to buy Massmart. So still a vote of confidence despite some of the hurdles we face.
Well, I think it's, if you look back in the last 3 months, we've had 3 South African companies in serious negotiations with international players. We've got on the IT side Data, we've got on the banking side Nedbank and HSBC, and now we have the Walmart Massmart issue. It shows you that South Africa incorporated companies are still in demand, and it's a vote of confidence in terms of the South African story and the story South African forming part of the rest of Africa. I do believe that we might see more of that. I think that if you look at the current yields, at the growth prospects of South Africa growing into Africa, I wouldn't be surprised if this trend is not going to continue for the foreseeable future. But I think the story here is more of an international story in terms of Africa is viewed as a growth opportunity going forward. South Africa has some great homegrown South Africa incorporated companies, and I think that's what they're looking at.
Would you go along with that, Dennis?
I do. I think it's an easy way of getting into the African-Asian sort of growth corridor, as it were. South African companies have got very good experience in Africa. They obviously, operating under the same sort of conditions. And I think those large corporations internationally are not seeing the growth that they'd like to see in developed countries, so they are starting to look at other opportunities.
Gents, we have to leave it there. Thanks both very much for coming in today.